Okay, welcome everyone. We'll start our fourth lesson, which is about our learning outcome 4. And in this lesson, we'll go through be able to recommend effective long-term and short-term sources of funding, sources of finance. My name is Anjum Satar, and my email address anjum@ukversity.co.uk. Please, if you have any question, just drop me email on my email address. Before starting this lesson, first of all, we recap, what we learned during our previous 3 lessons. So we'll quick recap first before starting our today lesson. So in lesson 1 we discuss about different costing techniques. We discuss about costing units. We discuss about marginal costing, absorption costing, and various other costing methods. Where we discuss about different cost centers as well. So in lesson 2, we discuss about 4 types of financial statement we prepare in accounts: statement of comprehensive income, statement of financial position, statement of change in equity, statement of cash flow. And we discuss 4 types of ratios. We discuss about profitability, liquidity, use of resources, and gearing ratio in our second lesson. And in lesson 3, we discuss about budget and budgetary control. So we discuss different types of budget: zero-based budget, incremental budget, fixed budget, flex budget. We discuss what is the difference between budgeted and actual, is also known as a variance. And we discuss how we can calculate variance. And we also learn about how we can prepare the cash budget as well. And we quoted example of the cash budget during our lesson 3. So lesson 4, today we'll go through and we'll discuss about different sources of funding. We have 3 assessment criteria. Assess the need of short-term working capital. Why we need short-term working capital in a business. Then the long-term funding within our organization, and which is I'll quite link with the 4.1 and 4.2. 4.2 is appropriate sources of short-term and funds for an organization. So justify the choices of sources of finance based on the cost and the risk criteria towards organization, which all will be focused in our discussion, which we'll go through. If you have any question, please drop me email. So we'll start our lesson. So welcome. We'll start our lesson. So I mentioned we have 3 command word, those used in 3 assessment criteria: assess, offer a reason, judgment of the standard and the quality of situation, skill informed by relevant facts. So when we'll address learning outcome 4, we need to assess, we need to reflect and appraise. Reflect means appraise, look back upon and appraise, relate stated aims, and give the table balance consideration to an issues or actions, why we are using this source of finance than others, which will, and justify, present the reasons case for action, why I want to go for short term, why I want to go for overdraft instead of bank loan, and different sources of finance will choose. So all this we'll discuss. So inductive contents we have, which supposed to be learned today lesson: sources of finance, type of funds, short-term, long-term, internal, external, venture capital, leverage, risk, cost, issues, technique of selecting appropriate sources of finance, different project, comparison of the cost and the risk. So all this will be focused. So please, you can rate yourself and rank yourself where we have in terms of the knowledge. Our knowledge way is 1 to 10 or not, or you're the 6, you're 7. So at the end of the lesson, you will see and you can look around. Either you learn, you move from, and how much confident you are after this lesson. So next now, first 4.1. So when we are looking the sources of finance. So before deciding the sources of finance, Nick, it's good to know the types of ownership. Type of ownership. Do you know types of ownership? If you want to start a business, you can be a sole trader. You can start as a partnership. You can start as a limited company, and under company can be a private, limited, and public limited. So you need to decide which nature of business. Are you are a non-profit organization such as charity. Yeah? So you have to decide which business you are in. So then you can decide based on these sources of finance as well. And always look, when you decide, you look your mission, you look your vision, and look values and corporate objective. So all you have to look these before deciding your sources of finance. So often is the hardest part of the starting a business is raising the money to get going. So entrepreneurial might have a great idea and the clear how to be turned into the success of the business. However, sufficient finance can't be raised. Of course, you need to be look around what sources, when and how long the finance you needed. You have to ask the question. Is it need for 1 year? Is it need for 2 years, 5 years, 10 years? What security can be provided? So what sort of the security you have to be? Maybe you have to be provided against the personal asset. If your business fail and your house is a pledge there, so can be you will be really at risk. So whether the entrepreneur is prepared give up some control of ownership. Yes, so you want to be look around, is a partnership you want to start, or you want to be start sole trader. So setup cost, so how much is the setup cost if you want to be start sole trader, partnership, or limited company? Starting up investment capacity, yes, you need to be look around how much fixed asset you need. Fixed asset, the asset which won't change within a year, the value will stay, like property, plant, equipment, computer, cars. These are the fixed asset, which is also known as a non-current asset. Then we need to be look around the working capital. Working capital is also known as a running capital. What known as is a key to understand for the short term working capital. So debtors is also known as trade receivables. What else also known as trade receivables? Why we have these? Due to the credit sales, and these known as credit customer. So you need to be look around, then plus inventory turnover days, how many days your inventory converting into finished good and selling it, minus your trade payable days. These also known as creditors, trade payables. And why we have? Due to the credit purchase from credit suppliers. So that's why you have this. So if you have trade receivable days plus trade payable plus inventory turnover days minus trade payable days, we can find is called working capital cycle. So these are called short-term asset, and we have to be managed. So if we have trade receivable days, first four is 30 days, inventory turnover days 10 days, so trade payable days maybe we'll try to arrange 70 days credit, 90 days credit, or maybe we can try at least 3 months credit from our. So that will provide us margin there. So because if we'll say 40 minus, so we have the working capital cycle is 60 days. We need to be look around in terms of, so we need to be balance this, and we have more liquidity assets. Okay, so that's we need to be always look around the current ratios when you decide. Okay, next, now sources of finance. A business has the variety of the choices it can make. How it's obtained the sources of finance need. A business needs to be assessed in different types of the finance based on the following: amount of the money required, how much money you required, how quickly the money you required, If you need a quickly money required, you don't have a money and you can go through payday lender. Yes, payday loan from shop. So normally these are very expensive loans. So you need a quick money. You don't have a cash and you need this now to meet your urgent needs. So that's why it's very crucial. And their rate can be maybe 30% interest rate, 40%, even 100% can be depends more than even 100%. So the cheapest option available. Always look to your costs. So think about it. Can be anybody knows what is a base rate? Base rate. Always look. Base rate is called basic interest rate, which is set by central bank. In other country is known as a state bank. Okay, so we have a base rate now due to the coronavirus is really low, is 0.01%, which is almost nothing. So plus if you borrow them from the bank, maybe bank will add their fees 2%. So bank can give you around 2.1% something. You can go around. So you need to make sure to measure the cost in term of, or if your credit scoring is poor, maybe bank charge you 7%, or bank charge you 10%. Yes, depends. So you have to decide how much 10% is the money you're going to be borrow from looking all possible options. Okay. Next now, the risk involved in the reasons for the cash. So the project which is less chance to the leading to the profit deems to be more risky one that does. So potential sources of expense, sources of finance, especially external, take into account may not be lend the money to the higher risk business project unless there is some short of the guarantee that there is the money will be returned. The length of the time required for the finance. A good entrepreneur will judge whether the finance is needed is for a long-term project or the short-term. Therefore, they decide whether the type of sources of finance wish to use. So you have to use. So short-term and the long-term. Short-term is need to be covered the day-to-day running expenses, which we call liquid assets, and it will be paid back a short period of time, which is normally less than a year. So that's called short term. Long term, which is mean more than a year, tends to be spent a large project that the payback our longer, more risky. So lenders more risky. So lender tends to ask you some form of. So lender asks you some form of insurance or security for the company if you can't pay it. A mortgage is an example of secure long-term finance. So main type of short-term finance is overdraft. Overdraft like account, overdraft for 30 days, 40 days, 60 days. Okay, then suppliers credit. So we can say suppliers, we can negotiate, they can provide us 90 days credit, and we have to be manage working capital. We can pay, we can get the money quicker from the customer, or we have invoices we can give to the lenders and they can give us the 80% or 60% of the invoice which we supposed to be receive money from, or which is normally the cheaper way to move forward. Okay, long-term sources of finance. The main type long-term sources of finance available to businesses are mortgage. So mortgages are quite long-term. Yes, we can buy the property. There are different types of, so repay and interest only. So repaid is mean including interest plus repayment, normally higher payment you have to make, and the interest only you have to pay just the interest. Bank loan can be long term, so loan can be different terms available, and you have to look around not just from one bank, different banks. So it's good to be look around different banks and different terms. Yes, and measure the cost and benefit and do cost and benefit analysis for these. So if I'll go from Lloyd's Bank, if I'll go HSBC Bank, if I'll go, so what rate, what term, my maybe first, some banks they say first 6 months you don't have to make any repayment. So that gives us plenty of, it's a mind, because of course if we don't have a new business we start and we don't have a cash inflow, we can't really pay it, because other bank maybe it's called, compound interest. So always we need to be look around. Share issues, yes, shares. So shares we have two types. Shares issue, we can issue shares if we are a limited company. So preference shares, you're paying fixed return normally on the preference, and ordinary shares. So where you have a voting rights, and shareholders can change the management. So we have to be balanced. And normally shares are expensive than equity. So equity, if you borrow the money from the bank, is a cheaper, like you pay 5%, 4% interest. But if you issue shares, shareholders want at least 10% return on their investment, because the reason is they're taking the risk. Maybe you pay them dividend or you don't pay them dividend, but if you don't pay them, they can withdraw it and can invest in other company. Debenture is also part of the long-term loans, can be secured, unsecured against the asset. Return profit, the previous year profit, if we are running business, that can be used. That's a easy. This is the internal source of finance as well. So we can look around hire purchase. Yes, your car can be purchased on a hire purchase agreement. You carry on paying the rent or the monthly installment. So you have to look around the cost, and you have to do cost and benefit analysis before making any decision. Not, set your mind, oh no, hire purchase is the better, but you have to consider in the short term, long term. And when you decide, and you always need to be think about the tax element, because if you have a debt, on the debt you're paying interest is expense, you're not paying any tax on it, so that tax saving is one of the key things as well. So you have to look around all, these things, and we have to be properly monitored. Okay, next now, short term and the long term. Short term is we discussed earlier, and the long term is more than a year. Next now we're looking now appraise appropriate sources of finance, short term, and the funds and the organization. In short term, businesses can raise the finance through the overdraft and the short term loan. Overdraft are the very flexible and can be arranged quickly and can be repaid quickly. Informed if the company can afford and do so. So we need to look around. However, the banks choose to, and it can be withdraw an overdraft facility at any time, because this is not, but normally the bank at least quarterly review it, and they should inform you before. But guys, be careful. In the UK now, on some overdraft is the interest rate is a 29% as well. So a short-term loan is a more formal arrangement which will be governed by the agreement, which specified exactly what the amount should be paid and when, and what the interest rate will be. So we need to be very careful with this. Okay. Next now, external sources. When we compare the internal sources of short term, so we can look around the external and internal both can be short term and the long term perspective in terms of the duration point of view. So this is the sources of finance suitable for the partnership business. The new partners can contribute the extra capital. Advantage doesn't have to repay and no interest, and diluting control of the partnership and the profit will be split the ways. So that's we need to be look around. External can be this source of finance suitable for limited company involve issuing more shares and the long-term sources of finance. So doesn't have to be repaid, no interest, and disadvantaged profit will be paid out the dividend. Leasing can be finance lease and operating lease. Finance lease is mean the asset will be yours, like a mortgage, repaid and interest only, which is exactly the same way the method allow the businesses obtain the asset without the need of the pay lump sum amount in front and they ran through the finance company. Leasing is like renting an asset and it involve set of repayment and this is medium term sources of finance. So we need to look around the businesses can have to be used up to date equipment immediately and the payment, so you have to make the decision. You go hire purchase. Yes, you can do hire purchase. This method allow businesses to obtain asset without need of the pay lump sum amount in front, and that can be and the business can have to be used up to date equipment. Of course, if you need equipment, you can use it and you can get it by using the hire purchase agreement with the company, and that is quite useful as well to raise the money in the business. So guys, this is also is a useful tool to use and raise the sources or the raise the money, and various companies using this hire purchase, and almost every company have some sort of hire purchase agreement. So especially cars can be hire purchase. Different machineries can be hire purchase. Yes, so even few equipment, different equipment. So equipments can be hire purchase. So that's we need to be look around. Then mortgage, as earlier we said, can be repaid, and mortgage is long term, normally 25 year. Even it can be more than 25. Different if based on different, and we'll carry on paying. And then you need to be decide is the fixed rate, or we can call fix or the flex. So think about the fixed rate, maybe your 4%. It won't change for next 2 years. So please always look around, because maybe you have a flex now is 2%. It can go up and down when the base rates change. So always you look around the forecast. If the base rate after 6 months, the bank at the central bank, or we call state bank, is the review after every 6 months. So if in the 6 months will goes 0.25% increase, so it can be in 6 months 2.25%. Next 6 months, then it can go up. For suppose it's at the minute is 2, if assume, then next 6 months bank will review again, it can increase again, it can go 2.5. Next 6 months is again bank want to increase, it can go up to 2.75, and the next 6 months, so it can go 3%. So you see there after every 6 month bank reviews. So either you take the fixed 4%, but if there is an increase after every 6 months, so that increasing by 0.25 and 3% in 2 years time. So maybe after 2 years the bank can start dropping the interest rate. It's not always upward trend, it can be downward trend, or go 3.5 25 3.5 3 point. So in 2 years time is further, it's in 4 years it can be reached up to 4%, and you day first you paying the 4% and you paying after 4 years you're paying 4%. So you have to make a decision based on looking the forecast and reading some financial journal and interpreting what is happening. Otherwise it's very difficult to, because the fix normally is not a right option. Trade creditors, yes, you need to be look around the trade creditors, how long you want, how much trade creditors you want, because trade credit can be 30 days, 40 days, 90 days. So you need a good negotiation skill that will help you to boost your cash flows. Okay, guys, always is good to be please, please, please. In almost every country, the lot of government grants is available. Especially in the UK, we have a different central government grants. We have, especially if you want to start the export business, the export fund is available. If you want to set up the website funds available. With a grant, it's you don't have to pay back. You need a business ideas you have, and you want to be in the government helping to boost the businesses. So these grants so don't have to be repaid, and there is a condition can be and the location can be. So please need to be look around. That's easy ways to look around. Venture capital, yes, we can look around the venture capital funding. Assured finance can be expert input, business out available, shared control can be, and short-term aims may have to be replaced the long-term goal. That can be look around the venture capital, pooling the capital into the form of the limited companies, venture capital companies, looking the investment opportunity in a fast-growing businesses, highly rated prospect, and may also buy out the firm and administration going concern. So you need to be look around these, and we have to decide. Anybody any question? Okay. The factor the affecting to choice is the purpose, the time period, the amount, ownership, and the size of the business. So you have to make the decision accordingly. Okay. Next, we're looking into justify the choices. So the sources of, so you have a mortgage, you have on this, you want that. Always look around and you justify. So you have to ask the question: is it capital expenditure you want to get the loan? Capital expenditure mean the spending money to buy the capital asset, which is property, plant, equipment. Then is the revenue is a day-to-day expenses, like you want cleaning machines, you want for cleaning you need a money. So these are called capital expenditure. You have to well aware of the difference and you can make the decision. Capital income is mean you can sell the capital asset and you can raise the money as well as the sources of finance. That can be even you selling more than now you bought it and you are gaining it. Revenue income is mean day-to-day sales, which is your normal business. You're generating the cash. You can look around and you can forecast. You can making the final decision which source of finance. So when you decide the source of finance, you need to be look around. Is it? It can be equity. Equity is a long-term sources of finance. Internally generated return, profit, earning can be, or you go for the issuing more shares. Other can be sources of finance is a long-term preference shares, medium-term leasing hire purchase, short-term trade credit and overdraft, and the special purpose government grant. So you have to look around the capital market is the long-term finance, and the money market is the medium and short term finance. So you need to be look around which source of finance you will use and why you will use this one. So when you issue shares to the public, so you always need to be keep in mind when you issue shares to the public, existing shareholder have the right. So you need to be look around what effect will be on the share price or the value of the share. So value of the existing share plus the proceed you have getting the money through the issuing new shares divided by the number of shares after the issue. After you issue more shares, how many shares now in circulation? So first, for suppose you have 20 million shares, so £5 was each. Now you issue further shares, and now you divide it. So you can find it what is the value of the new share or what effect will be the issuing on the old share. So because the shareholders always want to be gain it if their value is decreasing, maybe the old shareholders what they will do, they will try to be sell the shares And ultimately, instead of raising more money because our cash is going out from the business, that can create a problem in the long run as well. So you have to be justified which one is better, debt versus equity. Not lot of people say debt is cheaper. So debt you can get, earlier we said you can get from 2 to 5%, 6%, but equity normally is more than 10%. So equity is expensive than the debt. Another thing, you need the balance. So maybe 40% equity and 60% debt. That can be a mixture of it. And you always need to be look around the gearing ratio. Gearing ratio, we learn about the different ratios. You need to look around the liquidity ratio, liquid, how much worth of the current asset you have, liquidity ratios, and these ratios you have to calculate to decide which, you will go for the debt or you will go the equity. So equity owner, the business have the voting right. The debt holders higher the priority of the payment than the shareholder. The risk, the debt is low risk of the debt holders, high risk for the company. So equity is high risk for the shareholders and low risk for the company. Return, the debt holders willing to accept lower return due to the lower risk and the cheaper for the company. And the equity is want to be higher return, compensate for the higher risk and more expensive for the company. So that's, you need to be asked the question and you can go and you can make the decision accordingly. Okay, next now, financing short term and medium term. So can be difficult raising finance, small number of owner with the limited company and the lack of the business history and the proven record and the lower level of security account and the fund gap difficult in raising. So maturity gap is where the earliest small medium enterprise to raise the long term finance secured again the long term asset and the short term finance that may be preferred now. So sources of finance, small medium business angel, those are the rich people, venture capital, government assistance, supply chain financing and crowd financing can be a better sources of finance can be used for these small and medium sized enterprise. Okay, next now we can look around when you decide the sources of finance. Always good to be you calculate the weightage average cost of capital. So calculate the weightage of each sources of capital. So estimate the cost of each source and multiply the weightage of each source of capital by the cost and the sum of the average. So if you have weightage average cost of equity plus debt, so cost of debt divided by and the plus the tax saving as well, we need to keep in mind. So we can calculate by using this formula is called weightage average cost of capital, and average is more and this cost more, so we can shift around and we need to be make lower. Okay, so next we looking now is we have a video is quite good to watch, please. So that will help you further to enhance your understanding of different sources of finance and why we choose, and we can justify it as well. So next now I copied the link, so this is quite good. You can go through article that will help you to be further enhance your understanding about different sources of finance. So this is one of the ACCA articles. Selecting the sources of finance for the business can be raised internally, can be raised externally, like we explained. Can be necessary finance for internal sources. The debt to equity decision, if you make it, so you have to look around which one is the cheaper option. Then we been given the equity financing. If you go equity issue share, so you need to be asked some question. Duration of the loan, fixed or floating rate, the rate will change. The currency, if you're dealing with different currency, so like here we have a turnover, the company needs 100 million over the coming years for the expansion of the business. So last statement show the asset turnover is this, the cost is this, the profit will be this, which is given operating profit 120, interest charge is a 30, pre-tax profit, corporation tax, and after tax is we have profit after tax is 66. We paying dividend, so we have return earning is 26. So this include the depreciation of 16 million of worth of the asset, which will be, so we need to be look around as well, because that's a non-cash outgoing expense. So these are the our asset already. We have a debt, all debt is worth of 200, but if we look the creditors how much is worth of 170, so there is a 30. We are well off, because that's a debt to uh, liquidity ratio is quite good in term of. And then we look the dividend, and we have to pay, which is long term, and the tax we have to pay, still we have a liability. So without the expansion of the sale turnover, the cost and the dividend and working capital expected to grow by 10% coming year. The corporation bill is expected to be 120 million tax and the dividend. So required to calculate the net cash flow each, into, and then you can make the decision which one you will go ahead. So if we look here, we have turnover, we have a cost, we have an interest, we have, yes, dividend, we have increase in stock, increase in debtors, increase in, so net cash flow. So operating cash flow will be 40 point incoming. If remaining is 59.4 million need to be financed, 80 million cash balance is 80 million, then firm will have no need to be raised the external sources of finance. So we can make a decision based on this, and we can justify. So it's quite good to read these articles. Those will help you as well, and one other as well. You can copy and paste this, and you can read, please. And the quiz we have is all about the sources of finance. So you can copy this link. So please just play a quiz. At the end, it shows you all the answers as well. You can review them and go through. This will help you to develop good understanding about sources of finance, and which one and why, and what factor we need to keep in mind. So all this today lesson, sources of funding, where we can, and we discuss different internal, external, short term, long term, working capital, and we discuss about the base rate, interest rate, and on what basis we can make a decision and which source of finance will go through. Okay, thanks for attending. If you have any question, those are listening this recording, please drop me email on my email address anjum@ukversity.co.uk, and hope so I'll speak to you during our next lesson, which will be lesson 5, and which will be our last lesson for this unit. And thanks for attending or listening this recording. Thank you. Bye bye.